That's the S&P on the 3-minute. Are you ready for violence? Are you ready for violence? In it, bruv. In it, bruv. Are you ready for violence? Well, the good thing is we're still in that range. You know what I mean? Like we're in the same range. We've been in the range all day. So at least now we know when we actually break above A range, Something. We'll see. We shall see. Interesting. Anyways. Hi guys. No. Hi. You wanna know what's about to happen? You wanna know what's about to happen, guys? You wanna see this? No, that's not it. Uh okay. Let me play this. That's Big Daddy Powell coming to pump the market or crash it. One of the two. That's gonna be Powell when he cuts rates. When he cuts rates. Woo. When he cuts rates. Oh my goodness, he's gonna come in with. Woo. That's vibes. That is vibes. Anyways. Let's see. Okay, do we need to? How much time do we have? Oh wow, we only have 4 minutes left. Ooh, wow. Okay, I need to get ready. I need to get ready. What's the high of the day here? What time is this? 7, 9. Okay. Okay. Let's see. Uh, let's see if I'm ready. Even though I have a meeting at 11. It only takes 2 seconds. It only takes 2 seconds, and then the account is happy or not happy. So let's see. Yup. I hope it's not. We'll see. Let's see which way we go first, and then we look for the true direction. Oh lordy, I'm gonna be distracted by the way. So BTC to reverse. Okay, sounds good. Go all long. Yep, 50 contracts, and then. Anyways, it's looking like we're about to pop. Maybe virus is right. 5 minutes. Maybe I should close out my order. I have an order at the top, but that's not what I should do though. But probably should close it. Sheesh. Just straddle. Just one more dip for Joe. Yeah, Joe's gonna need one of those scam dips right before the stuff actually comes out. 50 contracts, all in. Whew. Peter, are you nervous? Justin, are you nervous? Yeah. Let's see. Place your bets. You're clenching. What will happen? Yup. 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 No, virus. It will pump stop loss. I think it's gonna pop. But then the issue is, Pavan, we could easily pop and then crash. Right? We could break the high of the day and then go to the abyss. 80% special. Virus, you know what? You're not help at all. Zero. 3 minutes, 3 minutes, and then volatility. 3 minutes. It adds up after so many. Yep. Yep, yep, yep. The market's about to cause chaos. 3 minutes. This is the last 3 minute candle, and then it's go time. I'm gonna switch my candles. I'm gonna switch them to regular candles so you can actually see what's. Come on, load. Sheesh. You can kind of see that we have like these two white lines, like the scribbles. That's the range we're in, right? So we're gonna need to break out of like one of these, one of these. So I reverse my at the bridge. Let's go. Come on. Okay, 2 minutes. 1 minute 40 seconds. Are you ready for some BTC violence, Gary? Virus reset here. He reset the account 4 times and said, "Nope, that's it. That's it." So that's it. I'm done with this. Ooh, here we go. How much time do we have? Okay, 1 minute 10 seconds. 1 minute 10 seconds. Are you waiting to the conference call, Dan, or you're looking like for now? On rebuild, if you yeah, yeah, Justin, yeah. 50 seconds, guys. 50, 50, 50, 50. Do, 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 do. 35. Do, 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 do. Are you ready to rumble? It almost looks like we scam up and I don't know. Let's see what happens here. Yeah, the conference call. Yeah, Joe's still in that trade. Oh my goodness, Joe's gonna. Yup. Joe needs like a scam up and then a crash. Is what he needs. What's 9:30? Okay. Here we go. Here we go. Here we go. Here we go. Joe's getting screwed in that trade. That's not looking very ready, is it? Yeah, see that initial reaction, like that scam up. That's not it, is it? Is it gonna go now though? Is that it? Yeah, this is still very still confused. Now it's really pumping. Oh, 506. What do you mean, pizza? A little bit more? You want to short it? Okay. Jeez, that's a crazy candle. Whoa, why are my candles like this? It's crazy. I wonder if that candle is gonna turn red and flush. Yee. This This is crazy. That entire candle went red. That entire candle went red. Really, Peter? Hmm. Oh, is this it now? Hmm. It seems like we're a bit confused, like in terms of which way it wants to go. Like it's not sure yet, but it's pushing though. I think better not turn around, otherwise it's gonna get slapped. Yeah, that's a brand new candle now. Oof. It's crushing right now. Which is, oh my goodness, these candles are confused. Oh, here we go, here we go, here we go. Maybe this is it. Which way do we go? See, we haven't even looked at like the actual article. I'll pull it up in a second here. Yeah, yeah, it's very confused. If that thing turns around, it's gonna crash. The virus is gonna be picking up a spire from the bridge. Oh, it's back to green though. That entire candle went back green. We won money and Dan won Scovy. Yeah, that entire candle went back green. This is the most like indecisive Fed meeting we've had. What's ish. Hmm. What are we gonna do? Pizza. Oh yeah. Yeah, pizza. No, you know the like again like that. So this first candle, that's the first reaction, right? Like that's the very first candle. But then it like it stayed in that direction. Um, yeah, yeah. I don't know what it's doing, but the S&P is green for the day though. It's green for the day. I did wait for the first. No, you yeah. Like that's the very first candle. Uh, yeah, I don't know. We'll see. We'll see. Is he gonna pump though, Tesh? Postponed? No. Yeah, I have a weird vibe. I have a weird vibe. Like it almost wants to crash and go straight to the abyss. We're erasing that entire candle now. Erasing the entire candle. Sheesh. This has to be like the most indecisive one we've played with so far. Like nothing. Like one direction and that's it. Maybe it's gonna pick a direction when he comes on. So 20 minutes. 20 minutes. Power comes on. Let me pull up the Federal Reserve. Yeah, so 2:30. When he's on, maybe when Powell comes on, be ready. Just be ready. Be ready. Uh-oh. This is indecisive. My goodness. Indecisive. Maybe we're just gonna run. Maybe, maybe. 506, 506. If we break above 503 and then virus, I'll believe you. But now I still smell scams. Mullen ate all your money. Well, virus could have told you that not to invest in Mullen. Anyways, uh oh, uh oh, uh oh, uh oh. My goodness, what is going on? Indecisions. Mm-mm. Uh, okay. Is Joe still in that trade? Hmm. If he is, that's brave. That's very brave. Watch, he sells and then it crashes. He's not in there anymore. Now it's gonna crash. If we still have hope. Yep. Yep. How many more days do you think it will have to keep up? Mullen doesn't have days. Mullen has hours to stay up, and then it crashes. I'm kidding, by the way. But put a stop loss. Oh, here we go. Here we go. Here we go. Maybe this is a. Uh-oh. Uh-oh. It's almost like we never really had anything. Hoping for a rate cut. Nope. Let me pull up CNBC really quickly here. Uh, la 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 la. Okay. Yeah, delay to cut as a yeah, nothing. Yes, what changed? Nothing. Like okay, well that's cool. That's cool. I'm surprised we didn't just flush on that news. Sheesh. It's almost like the market is like, you know what, we priced all of this rubbish in already. So like, what more do you want? And we sold off for you. What do you want now? Yep. Ooh. Now it's crashing. Uh-oh. That's a big red candle. Is it gonna hold up the 50? Oh, it's bouncing off the 50. Damn. It's bouncing off the 50 there. 75. I mean, it's still technically holding like the range, which is interesting. Uh-oh. What is it gonna do? Maybe the next candle. maybe the next candle. So that candle bounced off the 50. Yeah, this is a brand new candle now, though. So this candle could be interesting. This could be the it candle. This could be the death. That's if it drops below the last candle. It's not dropping below the last candle. My goodness. This is the most range bound FOMC. But yeah. Anyways, 18 minutes left, guys, and then he's on. Powell is on to speak his mind. Speak his mind. Tell you what he really thinks. Let me see. APVO. To which way do you guys think we go after the when he comes on? Which way do you guys think? Crypto's pumping. Yeah, it's interesting actually. Yeah, the markets are holding up better than so we just need to break out 506. Anybody else? Anybody else? Up. He thinks up. Says every time we need more data. Yep. Like it's always like that. The reason why we don't necessarily care about that is because either way there will be a reaction. There will be a reaction. So let's see. So let's see. Yeah, either we. Yeah, these candles are clearly confused. Clearly confused. Yeah, it almost seems like the market usually picks a side when he comes on, and then we pump or crash for like an hour. The entire time he's on, it's one direction. So let's see if that happens again here. We're bouncing already. To 485 end of the day, Jason? No. 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 Nope. Yeah, they're looking good. Virus, nice. Nice. No, I don't think we're gonna crash that low. This is still looking sus to me though. Still looking sus. Oh. Choo, 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 choo. It's all on Kobe. Yeah. And another candle. Yeah, it looks like the entire market is just waiting for him to come on. So 15 minutes. 15 minutes. 15 minutes. Maybe a scam wig to the downside, Troy, or where? What do you mean? I'm in futures and on YouTube stream. Let's go, Troy. Uh-oh. I'm putting puts on the opening of his big mouth. A scam wig down and then rally back up is what you think happens? Mm-hmm. Yeah, I'm not sure. Maybe that last fat red candle, maybe that was the scam wick. I just wanted to pick a side, and then go in that direction for like 10 minutes. Yeah, the 50. Yeah, the 50 is holding like a monster. Like a monster. It doesn't want to let go. It's like 50, you shall not pass. So if we break below that 50, oof, 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 oof. It will go all the sides. Yep. Dan, is your stop loss in on your position yet, or you're still waiting? Still waiting? What's the so did we just make yeah, that was the high of the day on that candle. Okay, so that last candle, that was the high of the day. So it's pointing to up almost. Yeah, exactly. Mash, nothing changed. These guys were never gonna give us anything. It's nothing new. What we wanted to benefit from though was the direction of the market, and it's really not doing anything. So what it's doing now, it's scamming everybody. Scamming. No, I can't. Uh, with each, okay, ATM future. Yeah, because it's going up and down really quickly. Then, so that seems cool. That seems very cool. Yeah, that seems cool. Just taking $125 over and over and over again. All of a sudden, big monies, big monies. Yeah, that seems like a really cool future, especially when it's doing stuff like this. How much time do we have? Okay, 12 minutes. 12 minutes. Ooh, 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 ooh. What is it gonna do? Sheesh, Dan. My goodness. Sheesh. Come on. Come on. Mm-mm. Okay. Do. What is it gonna do? Do. Yeah, at this point, I think we're just gonna have to wait for him to come on because it's not doing anything unless we just decide to explode here now. 10 minutes. 10 minutes. 10 minutes. 10 minutes. Oh, yeah, it's looking like it wants to rally. That 50 is impressive, though, isn't it? Sheesh. From the bottom to the tops. Mhm. Oh, yeah. We are confused. Yeah. Come on. Come on. Come on. Activity has been continued to expand at a solid pace. Jobs remain strong. Unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. Yeah, right. Who are you fooling? In the recent months, there's been a lack of further progress towards the commitment 2% inflation objective. Blah blah blah. Over the past year, outlook is uncertain. Economic. The committee remains highly attentive to inflation risk. Uh, Reducing a monthly redemption to okay, whatever. Yeah, meh, meh, meh. There's nothing on there. Yes, CYCC has been on fire. 78%. We've actually had some really good runners today. Surprisingly, some really good runs. Right, the one that we played with in the morning, CTMX, 200 and something percent. It's still kind of chilling up there, isn't it? All right, IMCC did well, kind of. CYCC has done well, it's still sitting at the highs. So there's been a few good names. A few good names. Mm, yeah, so we have 8 minutes and then he's on. 8 minutes. Blah, 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 blah. I hope it's like one direction. Just one color, Troy. Please give me one color. That's it. That's all I'm asking for. I don't want red, green, red, green. Just one color and then send it. That's it. Yeah. Let's go. Don't forget to smash the like, guys, if you haven't already, please and thank you. Hit that subscribe if you're new. Yeah, make it easy, Justin. One side. None of this. None of this. Like, what is this? What is this? What is this? Anyways, no. Usually when he comes on, it's one direction and up or down. Until he says something stupid. You can have brown. That sounds about right. That sounds about right. 7 minutes, guys. 7 minutes, and then I'm gonna pull up the conference, Z conference, and then we can hear him yap, 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 yap. No, 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 no. It does look like it wants to explode up, though, doesn't it? Oh, 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 oh. That thing looks like it wants to rally. Sheesh. Did Joe go take a shower? Oh my days. Hey up. Good thing you sold that position, Rob. Easy scalps for you. Because if you stayed in that scalp, oh my goodness. If you stayed in that scalp, sheesh. Sheesh. I would say, hello, Victoria. Can you call 911? Oh my goodness. Some positivity. There's been a lot of fear, hasn't there? It does look like it wants to go up. Like everything is pointing to up. That's if we break out. So break and go. Thank you, Virus. IRBT. And this one is just hitting highs on highs on highs. 83%. 83%. 5 minutes. With me at should have said you know what day it is exactly, Rob. Well, those guys don't know anything about the market though. Or care. Or care about the markets. Yeah, it looks like it looks like it wants to pop. Wait, how red are we overall? The markets are almost green. Colin sick. Oh, we're back to break even for the day, guys. We're back to break even for the day. Almost looking like we're ready to explode up here. 4 minutes. 4 minutes. Ooh, here we go, 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 here we go. It's about to bust. Yeah, it looks like it, doesn't it? Ooh, here we go, here we go, here we go, here we go. We just tapped new highs of the day here. Oh yeah. The markets have been so there you go, highs of the day. There goes new highs and new highs. And we have 3 minutes before he's on. The New highs. No Diddy, please. Time to pump or scam? Yeah. So he's on in less than 3 minutes. Do, 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 do. If we see 5 or 6, that'll be really impressive, Iris. Ooh, here we go. New highs of the day. The only thing that's concerning is how we go up and then we come down a little bit and then we push again and then we come down a little bit, almost like it's unsure. You know, almost like it has no clue what it wants to do, but it's trending up. Magneted down. Yeah, no, the 50 EMA has been a nice level to bounce back up at. 2 minutes, guys. 2 minutes. 2 minutes. I'll be impressed too. Exactly. This would be a clear message to you that the market is always 10 steps ahead, right? The market is always 10 steps ahead in terms of like pricing in these no rate hikes. So the fact that the Fed is sounding like that and the market is green, that should send a clear message. Market no give a damn. Oh, here we go. Here we go. How much time do we have? We have a minute left. 5 or 3 almost. Almost. You guys ready to see what's gonna happen one more time? That's Powell, by the way. Okay, let me switch the let me share the other let me share the oh, silly. Okay. So it's just the stupid music for now. Just the stupid music for now. But the market, the SPY just broke above 503 for this monthly drama. Ron, it's very important. Yeah, don't forget to smash a like, guys, if you haven't already, please, and thank you. He falls off stage. Oh my goodness, we do look strong though. We do look strong. So for now, until he comes on, and then let's see what happens. And then let's see what happens. Back below 503 here. Here we go. Here we go. Monthly drama. Here we go. No more stressing. Exactly. Just crash it or pump it. One of the two. Ayo, Justin. Ayo. Yeah, it looks like we want to. It looks like we want to just keep going up here. So let's see. Gordon Ramsay on MasterChef. We plan to raise. Oh, here he comes.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful? And ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored?
or anchored, stable, roughly? Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data answer to that question. That would include inflation, inflation expectations and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timros of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that. No, I mean the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get, our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up. And of course, he's Mr. Potential Growth, our star. Do you share that view? And would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things. And if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that, but they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think roughly. So yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expected that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates. Whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
We done? Dunskies? Okay, let me pull up the S&P because SPY is about to get slapped. There it goes. That thing looked bridgy. It's about to get slapped. Unless we magically bounce back and go to the top again, Joe. But, ooh, look at that wick. No, I think we, let me get some music here. Doo-doo-doo. Some music. You actually wanted to crash all the way back down, Joe? Oh my goodness. Well, let's see where this candle closes, because I think this candle is going to be very telling. We only have 30 minutes left, actually. I always forget that, like, when he's done, the market is basically about to close. If we crash all the way down, that would be crazy. That would be crazy. Imagine. Straight to the abyss. Nope, and a bounce. Let's see where this new candle closes, actually. Oh, wow. Yeah, maybe we just retest the 9 EMA then. Interesting. Yeah, that candle looks bridgy, but at the same time, it looks like it could. Doo-doo-doo. Here we go. I just want to see where this candle closes, and then we should be good. Are we gonna crash it? Are we gonna crash it? That candle looks like it's about to die, but at the same time, it looks like it wants to rally. Interesting. Are you impressed? I am impressed. I am impressed. Let's see what happens here now, though. Now that he's done, oof. Yeah, now that he's done, I think we might just go back to the abyss. Usually, that's what happens. Usually. Are you back to even on that short, Joe? Or you're still in there? Closes the other curtains. Yep. Yeah, let's see. Yeah, there's only 30 minutes left, so flush it back down. Yeah, maybe. Maybe. There's a bit of support here, so we'll see. I mean, at the end of the day, though, that's a pretty nice rebound. Unless we lose it all. 11 points? Okay. Unless we lose it all, I think it's a fairly good day for the market. Right? So we basically priced in the no rate cuts, and that's exactly what we got. So then the market says, oh, okay, cool. Back to green. Sheesh, Joe, look at that bounce on that candle there. Damn. Sheesh. 3:30. Yeah. Staircasing up, E? Okay. Scam. Yeah, there's always a scam, though. There's always a scam. Yeah, this candle looks like we could retest those the 9 at least. Oof. Yep, there's your retest of the 9. Wonder if we go back to the lines of comforting. Yeah. Did you take a shower yet, Joe? Joe was in the trade and he wanted to go take a shower, but then, yep. But then, oof! Oh my! Look at that. Yeah, maybe we push back to the top of the range, Joe. I hope you got rid of that thing. Otherwise, back to red. Uh, okay. Yeah, let's see what happens. Yeah, let's see what happens. Today is, yeah. Let's see what happens in 5 minutes. Yeah, honestly, that's not a bad gamble virus, is it? You know, take like some ODTEs, puts and calls, and you're bound to get some sweet volatility. The only issue though is like that stuff is usually priced in on days like this. Everybody knows that it's coming, right? So then they don't exactly sell those things for cheap. Mirror position had to take them. Nice virus. Nice. Nice. Yeah, let's hang out for a few more minutes and then call it a day. I don't think there's anything important happening tonight, is there? Nah, there's nothing on here that I like. Yeah, it's Apple and Coinbase tomorrow, and DraftKings and some of the other names. But today's fairly like, yeah. Yeah, today, I think again everybody knew that the Fed was speaking, so there's really no need to no need for anything special, you know. Joe, did you close your short yet? That thing looks dangerous there. That thing looks dangerous there, Joe. Oh, I see why. Yeah, it's gonna break out. 3, 2, 3, 2, and there goes your breakout. If I get more, oh geez, oh look at, oh my goodness, look at that candle. Yeah, Tesla actually did really well, really well. Yeah, the close of this candle is going to be important for you, Joe, if you're still in there. Really important. We should be close to the top, you would think. You would think. Maybe in 3 minutes, like Pavan said. Maybe in 3 minutes. Found the back door. Did you found something? Yeah, market close. Yeah. Puts? You buying some puts? Okay. Let me get the link here. Actually. One second. Let me send this over to. Silly. There goes your redness. Yeah. BTC dips more. Was this the morning? No. I think you might have had your dip this morning. Right. So depending on what happens to, I think we will really tell Joe, Jeff, sorry, with in terms of like what happens tomorrow. I think tomorrow should be really telling. Like tomorrow is usually like the day after is usually the day. Like if we continue pushing tomorrow, and then it's done skis. Like the dip surprised in, and then we go. So it's gonna be all about tomorrow. Right? Today is kind of skewed by like other stuff like manipulation, blah blah blah, and then tomorrow's like the after the fact reaction. You get to see like the real face, and then you're like, oh, okay, that was the bottom, right? Jeff, I know that's not exactly what you want, but usually the Fed meeting stuff is like this: chaos, and then we get some proper juice tomorrow. Some proper juice tomorrow. Are we gonna keep crashing now? Let's see where this candle closes. So 2 minutes left actually on that candle. That's a lot of time. It's a lot of time. It's a lot of time. You're back in the we better? Yeah. That's a really nice dividend. That's a really nice dividend. That's an amazing dividend. So congratulations. Where's the 50 on this actually, Joe? Oof, yeah, it's all the way down there. So there's still some room to the downside, unless we bounce up the left-hand candle there. Room to the downside. If we break below that candle, then we'll probably go into the 50. Okay, let's do that. Yep, there he goes. There he goes. Dipskis. Okay. What about... Yeah, there you go, Joe. There you go. You get what's already stretched. Yep, there it goes. Yep, here comes the 50. Here comes the 50. Oh, I see. Okay. There he goes. So it's kind of bouncing off that level. Yeah. Okay. There goes your bounce too. Almost 5 now, CTMX. Okay. That's actually a really nice bounce, yeah. Let's do this. La, la, la. The ancestors. Yeah, it's all the way down there, Joe. I don't know if you're gonna get that, but we'll see. We shall see. Yeah, Tesla's getting slapped now too, so we might have hit the top. That's usually the case when he's done speaking. That's usually the case. You know, he finishes and then we've hit the top already. So yeah, CTMX looks really good actually. Yep. Oh my goodness, that thing. Wow. Yeah, still a ways to go before the highs of the day, but that's a pretty nice push. No. You're in 3 shorts? Okay. 3 shorts. No. No. One second. There you go. What do we add? SPY. Oh my goodness, SPY. Sheesh, that thing is about to go back to even. Just keep on these dips. Okay, there you go, Jeff. Yeah, don't buy too much on like on one dip, because then you end up. See you later, Gary. Have a wonderful evening. Yeah, like we're going back down. This is why honestly, like the day of the Fed, like it's whatever. Like it's just volatility manipulation because then the next day you actually have the direction of because like now it's like okay, well whatever, we're going down already. What changed? It's just market makers scamming the markets. You know what I mean? So this doesn't change anything, right? Like I've said this multiple times, like usually the Fed meeting and then we resume the trend. So hopefully we don't resume the selling trend, which I mean it looks like it's doing that, right? So yeah, it was new shorts day, yeah. Yeah, you guys just keep buying the BTIO dips. Don't buy too many dips at the same time, please. Back to new highs on Monday. Maybe. Yeah, Tesla is getting slapped. Sheesh, the entire market is getting slapped. Is Tesla back to red? Yeah, Tesla is back to red for the day. 5 on that short, Joe? Wow, 4 contracts, 5? Wow. My goodness, that's nice. And it's still dropping. Still dropping. That was a nice top. That was a nice stolly top. Nice. Yeah. You're done? Oh, that's good. Well done. Well done, skis. Uh, uh, 181. So you're green on your entire position now. You're green on your even though Tesla is still dipping, like you're green on your entire position now, Kimbella. So that's good. So even though it looked like you bought really high, is that an alert? No. Okay. Yeah. Losing monies. Oi. Losing monies. What's this one doing? Wow, CYCC got entered. My goodness. My goodness. Yeah, hopefully we don't continue this. Otherwise, we're gonna sell off again tomorrow. And if we sell off tomorrow, I think we're gonna sell off. You know what? Have you guys? Maybe this is good for you, Jeff. Have you guys heard that expression of like sell in May and go away? Sell in May and go away, because the market is usually rubbish. That would be the same thing for crypto, right? So sell in May. You guys heard that? See, all of these are just. I actually just want to see. I yeah. Definition. Finance performance during the 6 month period, May to October. Okay. Yeah. See, this is like all. This is May to October though, so it might not count this year because of elections. Must be a stupid Canadian thing. No, like it's a real stock market thing. Like it's a real thing. Like look at the market calendar. Like think of when the market bottomed last year, right? The market bottomed in October. If you bought the S&P in October, boom skis, all time highs, right? It's usually like May to October. The market just does like stupid stuff, like down, 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 down. But obviously, with elections this year, we might just maybe it's only May this year, and then June we go back up. But in recent years, with the S&P index gaining 2% from May to October, since look at that, the S&P gains 2%. The S&P gains 2% since 1990, 2% from May all the way to October, right? Yeah, and then look at this, right? 7%, which is exactly what what we've seen, right? So look at that. 7% from October to April, which is exactly what's happened, right? From November of last year to April of this year, all time highs, right? So this is why it's a real thing. So most of the gains come in November all the way to April. Again, it might be different this year because of elections, but who the hell knows? Referring to la 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 la. I'll post this in Discord for those of you guys that are interested. Uh, Sell in May and go away. Yeah, I wonder. I wonder if it's the same this year. Sell in May. Didn't they have in in who? Where? Yeah, this is why Pablo leaves for the Dominican. Yup. Yup. I thought that was the rule for crypto season. I'm not sure. Not sure. Seasonal. Markets are once influenced by bad title. La, la, la. Farming. I wish there was like one for the election though. But then again, yeah, look at this. 2011 minus 8% from May to October. May to October. 2012 1%. 2013. See, we need to find those election years and then we can kind of compare. Was 2020 an election year? I think so, right? 2020 was an election year? I think. I don't know if I. And then 16. Yeah, there doesn't seem to be. Anyways, we'll see. We shall see. Yeah, tomorrow should be a really big test. Oh my goodness, look at yeah, Tesla lost a lot of those gains. Wow. A lot of the gains entered. The rigged ones. That's funny. You want me to sell my my no, I'm not saying sell. Like it's okay. Like if you're holding and you're getting dividends, like even if it goes, like let's say the market, like even if it's 1% or the market doesn't move, like you're still getting your divvies, Jeff. Yeah, it's trying to chicken. Oh my goodness. Yep. Yep. Yeah, CTMX. Yeah. Mm, la, 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 la. Uh, uh, mm. Okay, there we go. Cook him. Cook. Damn virus. Sheesh. Access to. Yeah. Jeff has a farm, so. Oof. This is not looking good. This is not looking good. The market is gonna get slapped tomorrow, isn't it? Well, like we went from 508. Sheesh. 508. Straight to the abyss. Picked up some more for next week, 510s. Okay. Yeah, don't forget to smash a like, guys, if you haven't already. Please and thank you. Please and thank you. Sell in May and go away. Mm. Choo. 1 second. 7. Hmm. Two. I no, you're tired. Oh my goodness, violence. That's why. Okay. CTMX. I would laugh if the market closed. If the market was about to close and we were red. Maybe we can test the 200 there. Because it's looking like that. Looking like a bridge. Yeah, I agree actually. How's that a thing? Two. Yup. We're red for the day. Red. Tesla is at 181. Oh, Tesla is gonna get slapped. Oof. Oof. Yeah, this is yup. It's finished. It's finished. Oh my goodness. How much time do we have? 8 minutes. 8 minutes of pure disaster. Oh, tomorrow could be bloody. Tomorrow could be bloody. Sell in Maine, go away. Sell in Maine, go away. I one Tesla at 170, 170. Yeah. Yup. Again, I said this earlier, right? Yes, the Fed meeting, but the trend always resumes. So if the trend was down before the Fed meeting, that we pump and then we sell off. 8 minutes of pure tomatoes. Yup. Straight tomatoes. Let me see. Oh, I see why. Okay. Straight tomatoes. Buy in June, boom skis to the moon. Exactly, June. Yeah, June into elections. So maybe, yeah, May might be a disaster. Might be a disaster. A disaster. Yup. Zinbio, thank you for the super chat. Was the Fed meeting positive or negative? It was. Interesting. That's a good question. It wasn't positive, and it wasn't negative in the sense that we knew exactly what they were gonna say, but it wasn't positive. So negative, I guess. Let's use negative. Let's use negative. Uh, right. The market only bounced. Yeah. The market only bounced because everything the Fed was gonna say we knew already. Right. So there wasn't a surprise, but it wasn't positive. Like they gave us nothing, zero. Thank you for the super chat. I think I missed your question then. Um, right. So the keeping rates the same. They're gonna continue to look at data to determine what to do next. They're not cutting. Anyways, like it's the same rubbish. Alrighty. So nothing new. Nothing new. But yup. Look at that. Oof. There's no look good. Let me take a look at these ones. Is consolidating. Yeah, it's the same. So usually the markets know what the Fed is going to do, and then we sell. So yeah, that was a really nice top. As soon as he was done speaking, that was the top. It usually is, or the bottom, and then straight to the abyss. Straight to the abyss. Oh my days, was slapping down. Sheesh. Straight to the abyss. The markets are, if you think about it though, the markets are really not that far down, right? Like we're down what? Like we're down $1 on the S&P. So the only problem though is how this sets up for tomorrow, right? How this sets up for tomorrow. Tomorrow. Like chaos, right? Chaos. Okay, perfect. Yep. For overnight gap up sets up for the virus, that seems like a prayer more than. You think we gap up tomorrow? Yeah, no, we'll see. I hope we gap up too. I hope we gap up to 338. Okay. Mhm. 2. Not financial advice. You actually think we gap up tomorrow, Virus? I'd be surprised if we gapped up. Usually, when we set up like this and we sell off, it's usually a gap down, and then maybe we turn around like tomorrow morning and find the base and then go back up. But usually, the week close. I mean, we're coming to the bottom. Oh my goodness! Look at that. Damn! Look at that. Sheesh. Market makers win again. I have time on everything. My expiration are those 200 calls, 510s. Okay, yeah. All back, Joe. All back. All back. All of it. No financial advice. I like it. What time is it? Okay, we have 2 minutes left, guys. 2 minutes, and then we can hop off and go play some after hour movers in Discord. So again, don't forget to smash a like if you haven't already, please, and thank you. Hit that subscribe if you're new, and if you're not a member yet, you're missing out. So click the link at the bottom of the chat. Come join us. 6. Interesting. I just saw you were still on. Oh, Joe. Sounds good. What a day! $8 up, $8 down exactly. So, yeah. This is why the Fed meetings, honestly, they're always. That's why I keep complaining about the Fed meetings, because the market knows exactly what's coming, but the Fed meeting is a complete scam. So you can never use the Fed meeting unless like it's clear. You can never use the Fed meeting and the market direction as like, oh, the Fed broke up, the S&P broke above this level. Oh, now we're gonna pump it. SPY broke above 508, 507. Now we're going to the moon. It doesn't work like that, right? It's like a scam up, a scam down, a scam down, a scam up. So the levels on days like today don't mean anything. Nothing at all. Nothing at all. They're just, they're just meant to play the volatility. Play the volatility, take your money and run. Take your monies and run. Did we just close? Yeah. You know what's crazy is Tesla closed below 180. Tesla closed below 180. That's crazy. That's impressive. That's very impressive. Very, very impressive. Anyways, any last questions, guys? And then we can hop off and go back to Discord. Any last questions? Yeah, SPY is about to slap again. Na. 8. Okay. 1 second. 47. 4. Cool. Alrighty, y'all. I sitting on a donut. Have a wonderful evening, guys. Be safe, and I'll catch you guys in Discord. Alrighty, y'all. Again, be safe. Much love. See you guys in Discord. Bye, virus. Yeah.